at what we're seeing is a real height of consumer debt per person, of national debt in terms of not the overall level of treasuries, but the fact that the Treasury Department can't even rely on remittances from its own Fed, and the Fed's operating at a loss. These are things that have never happened in our history. And if we look at the regular person on the street, actually, retail is kind of, puts them in as a consumer perspective, but someone with real bills and real debt. There is a squeeze right now going on in terms of debt. And what happens when you can't borrow more because you can't afford to pay, or you default, or you go delinquent on the debt you already have, you break. That's the same thing with a corporation. That's the same thing with a human. Now, the United States isn't going to break because it's the United States and it can issue debt forever. But from the standpoint of a person on the ground, their own buying power, I think what we're seeing is they have been strong, but they've been strong on debt. And you cannot be strong on debt forever. And when that does break, that's when consumption goes down significantly. That's when delinquencies go up. That's when these open office spaces and commercial real estate has another bout of negativity. That's when banks start to close and have more problems. So there is this potential redomino effect of debt being pushed beyond its brink. So we've seen a lot of layoffs in various industries and from various companies. If I look at the labor environment from the standpoint of someone can have multiple jobs, and that counts in terms of payroll, and that counts in terms of employment figures, I think we are seeing, and we know that's the case, and that's not necessarily how the Bureau of Labor Statistics or even the Fed really looks at labor. From that standpoint, I think people are going to continue to be resourceful, and we're going to see some of the meta figures look good because of how people are involved in the labor force, how their participation actually is, rather than what it looks like at the surface. So from the standpoint of surface numbers, I'm not as concerned. From the standpoint of individuals being pushed to a brink, and then again, you throw into that debt and the financing hardships that can come from that, I do have a concern. What we've seen recently is a bit of a slowing down in, for example, U.S. GDP this year. We just saw the print of 1.6% increase, which is not 3.4%, 3.2%, which it was. So there is a slowing down of economic growth. There's a massive increase of debt since the last time, which has created an expense, a monetary policy expense for what the Fed has done with its rate policy. So we're now in a pause situation with interest rates, but the cost of financing our debt, basically servicing our interest payments, is approaching $500 billion per year. That's a drag on the budget. That's a drag on the economy. That's a drag on the ability to actually create real things with real commodities. And this is very, very unique to an extent to the United States, this distortion between its monetary policy, debt increase, and what we're now seeing with a slowdown in growth in GDP. In contrast, some of the countries outside of sort of the Western Bloc, for example, China and India, are actually seeing turnarounds in their economic figures. They're showing less of a debt-driven economy, and they're also increasing their pull on natural resources for energy transformations, battery storage, and technological AI factory developments, as well as infrastructure building. So what we're seeing now is actually a global distortion amongst blocks of countries, I think, with respect to the trajectory of economies versus debt versus monetary policy and inflation. From a standpoint of the fact that the Federal Reserve has been a buyer of our debt, for example, we've seen this massive increase in debt. We don't exactly know to what extent it has gone into the economy. It's definitely inflated markets, the fact that over the last year or so, there's been a sense that the Fed is going to cut rates or somehow go into some form of quantitative easing from quantitative tightening, period. So from that standpoint, even though we've had rocky periods in the stock markets and in the NASDAQ and the S&P and so forth, we're predominantly much higher. Investors do like that. Investors like the idea that not so much that there's debt, but that there's a buyer for that debt. And there's a possibility of reducing the cost of that debt now, which comes from the Fed. That said, what the Fed just did in its last meeting is say that they're going to reduce the amount of debt that they let taper off of their books. In other words, to cut back quantitative tightening. What does that mean? They re-step in and reaffirm their role as a buyer, or at least a holder of a massive amount of U.S. debt in both Treasury and mortgage, which link to treasury assets. So this is a distortion as well. From an investor standpoint, it means that the Fed, regardless of what it says about fighting inflation with interest rate policy, still has a massive book of debt and is willing to pretty much hold on to that massive book of debt with some adjustments going forward, which means even though we're borrowing more, we have a buyer. That said, other countries are not buying as much of our debt, not on an absolute basis and also not on a percentage basis. So we have just ballooned massively. And they have basically kept, for example, China, the same 1 trillion or so dollars worth of US treasuries on their books. What does that mean? They're finding other places to invest, which are not in United States debt. And this goes back to what I was saying before. From an investment standpoint, yes, we've seen upside because of the possibility of all of this happening. But on the same token, we haven't invested in as much of our absolute growth, our actual growth. We've had factory development in the Midwest. We've had money come out of the CHIPS Act, $30 billion recently for chip manufacturing in the United States. All of these things are part of growth, but we've had massive underinvestment in infrastructure, from everything from falling apart bridges to roads to highways to communication systems to energy transformation systems and our power grid. So what this means is we're evolving into a period where we're going to have an even more slowdown in growth. And from an investment standpoint, we're going to have to be more particular about where we invest in products and in commodities that drive those products outside of the United States and not merely in the United States markets. The plan of the central bankers, I think, initially after the financial crisis, as I started inclusion and worked through the years past that in that book, was to basically calm down the markets. It was to sustain the banking system, do the bailouts, make sure that banks around the world weren't still being compromised by the risks that were inherent to the system, or at least not on their surface. Since then we've seen Credit Suisse go under, we've seen a lot of regional banks go under. Many things have happened since then which haven't been quite what they designed or maybe would have envisioned, but did sort of work in terms of they created a lot of money for financial systems, and that money did go to its intended purposes. And of course, COVID, we sort of doubled down on that, particularly with the US and other central banks, to basically accommodate the shortfalls in just movement and economic movement, supply and so forth. But I think right now we're at an interesting point where they're still trying to do the old playbook, but the rules around them have been changing, or the actual events around them, the supply chains around them have become less controllable. When it was just about money, when it was just about banks, when it was just about, plugging the holes in massive derivatives positions, that was one thing that the central banks could sort of get together and figure out a way to collude and control to an extent and to calm down. Now that we're in this period where it's more about inflation that I believe is connected to supply chains, to geopolitics, whether that's the Middle East and oil, whether that's Ukraine and Russia and other forms of natural resources, wheat, grain, etc. All of these things are outside the purview of central banks. So what does that mean now? They're still trying to connect. They're still trying to have swap lines with each other and have rates, sort of accommodate where they believe they can tweak economies, but they can't control them. So that's why it goes back to my other point, which is now we're in this period where China's saying, you know what? We're going to be double downing on our infrastructure at home, lending to countries around us, augmenting our trading relationships with Brazil and other countries that are developing and have natural resources outside of us, building plants there. The United States is trying to figure out how to be competitive in that world. The mining and natural resource and energy and battery storage community is trying to figure out how and where those supply chains are going to be grown over the years. So, for example, I was just in Brazil, and one of the big things there is growing its standing in rare earth minerals, rare earth elements, which are used in everything, from us conversing over this medium, through our computers to our iPhones to battery storage to EVs to space to defense and so forth. And they're trying to figure out, all right, well, how do we work with the rest of the world on what is a large stockpile of rare earths right now, and how does that play into economies? How does that play into a role between the US and China, allied supply versus competitive supply? So I'm saying a lot of phrases here, but really it's a very interesting transitional period in the world right now, both away from what central banks believe and can control to real things and where they're going and who's providing them and who's processing them. Basically, what we saw back in the financial crisis of 2008, which led to collusion and this massive overreach of the Fed and other central banks in terms of printing money, buying debt, QE, and the like, is that other countries got scared, whether that's China, the EU countries, even though we have very strong alliances there from the US and EU countries, India and so forth, and said, look, if the United States can have so little control over its financial system, that all of these elements can coincide to create a big financial crisis, which can bring down an economy, and then you have Fed policy go to zero interest rates, you have a large amount of debt, you have buying of that debt, all of these sort of new elements to monetary policy that other countries just have to sort of abide by and be involved in, because we have currency relationships and swap lines and banking relationships globally. And so that began this entire development of the BRICS and BRICS Plus nations to trade more with each other, not necessarily to create their own currency. That's something they continue to look at. And now with digitalization, it's something that's actually accelerating. I was just in Brazil talking about how the G20 is going to talk about digitalization, that's a hard word to say, and a global payment system, which is akin to our FedNow US payment system, and how that's going to work in terms of moving money quickly without a real currency backdrop, almost uber central banks around the world, even though central banks will be involved in controlling it. So there is this idea of collusion where other countries had to abide by US policy. They had to reduce their rates at the same time. They had to be involved in swap lines. They had to deal with banking systems. And over the years, though, it made them solidify their relationships with each other. And all of these years since now, we're going into 2024 from 2008. So we're talking about 16 years here, 18 years of change in this period that we're seeing in the next couple of years. This is something that is going to continue that superpower shift towards China and its allies. When I say allies, I mean trading partners, debt partners, lending partners, extraction of mining and processing partners, into something that's stronger and stronger. India is a part of this as well. There obviously have relationships with us and China, but this has been happening, and now it is accelerating because of the supply-demand chain and commodity pull. That's also a part of where we're moving towards as general economic growth and technologies develop.